Hello friend, welcome to my channel and I'm going to show how stock market work. If you are thinking of investments that could beat inflation and also give you good returns, one option might be to start investing in the stock market. If you have decided to do the same and go for it all by yourself, it's not a bad idea. The stock market, when properly understood, can help you make a lot of money, but you can also lose all your money if you are tempted to invest randomly without knowing the nitty-gritty of the market. Therefore, there are a few things you must know before you dive into the share market. Here they go. Number 1. Never jump blindly into stock markets. Many a times it happens that while talking to your friends and colleagues, the discussion heads towards the stock market, and also how the stock market helps investors make big money. You might never have invested in the market, but after hearing about all those things, you also decide to buy some stocks. However, if you entered the market just to remain in the mainstream fashion, you have landed in for the wrong reason. You should invest in the stock market after getting the basic knowledge about it and in accordance with your financial goals. Number 2. Stock market is not a money-making machine. You must have heard the story about many investors who made their fortune through the market. Many believe that the stock market is like a money-making machine, which can turn them into millionaires over a period of time. Well, it is true that a lot of investors have made profits through the stock market. But it was only possible because they've good market knowledge, made some really smart choices by adopting carefully thought of strategies, and are also much disciplined in their approach. Many people forget that a lot of people have lost their entire wealth, while some have been forced to sell their personal assets to cover the loss in the market. Number 3. Educate yourself. Handle basics first before making your first investment. Take the time to learn the basics about the stock market and the individual securities composing the market. There is an old adage, it is not a stock market, but a market of stocks. Your focus will be upon individual securities which you are investing in and the relationship with the broader economy and the factors that drive your stock. Some important areas which you should be familiar with before entering the market are understanding financial metrics and definitions such as P, EPS, ROE, market cap, and so on. Popular methods of stock selection and timing, such as fundamental and technical analyses, trading basics, rules, compliances, and terminology as market order types, including market orders, limit order, stop market orders, stop limit orders, trailing stop loss orders, and other types commonly used by investors, margin money required if you want to trade in F&O. Gain some understanding about the market and its relationship with the economy, such as market relationship with inflation, GDP, fiscal deficit, crude prices, rupees values against dollar. People lose money in the markets because they simply jump to the market without understanding the economic and investment market cycles. Number 4. Invest only your surplus funds. The biggest mistake newbie investors make is to invest money that they can't actually afford to lose. Investing in the stock market is risky, and that means that you can potentially lose everything. Like any investment, there are inherent risks associated with the stock market. Some other risks related to the overall market is systematic risk that you can't avoid by diversifying your portfolio, while some risks are stock specific that you can avoid. You need to decide your own risk tolerance considering your age, financial strength, retirement goal, etc., and accordingly should take the risk. If you want to take risk in the stock market, then only invest your surplus funds which you can afford to lose. Investment is done to generate more money, but do not invest all your emergency funds in the stock market. Number 5. Avoid leverage. Leverage simply means use of borrowed money to execute your stock market strategy. In a margin account, banks and brokerage firms can lend your money to buy stocks. It sounds great when the stock market is moving up, but consider the other side when the stock market or your stock goes down. In that case, your loss would not only erode your initial investment, but you will also have to pay interest to the broker. Leverage is, thus, a tool, neither good nor bad. However, it is best used after you gain experience and confidence about your decision-making abilities. Therefore, limit your risk when you are starting out to ensure you can profit over the long term. I hope you understand. Thanks for watching.